All right, introduction to infrastructure investing. This is my personal forte, and it's everything that I've done and spent a lot of my career doing. It's just a bit of an introduction. When we refer to infrastructure, we're referring to anything physical and organizational structures as well that are necessary for societies and economies to function. So these are energy, transportation, telecom, social services like hospitals, schools, even government buildings can fall into that category as well. These play a vital role in economic development. They can improve the quality of life and they allow for countries to grow and develop. It's like a game of civilization, and countries need to level up their infrastructure over time. So, my personal reasons behind investing in infrastructure is when we look at what are the the bread and butter of stocks, consistent stocks that we can stay behind of. We got like the P&G, the non-durables. Infrastructure is that from an investment perspective, that it's the backbone of any country and facility. So it's got less risk than other organizations that you possibly invest in. So you've got much longer term investments. A lot of the contracts are structured over durations that exceed 15 years. Their returns are stable, so you can project where your investment's going, what you're going to make over a certain period of time. And there's a lot of capital appreciation of that asset as well, depending on how you manage it. They, as I said, look, they sit differently from other asset classes because they are the backbone of an economy and a country to function. So without countries paying their bills on these sorts of investments, they fail to function. And that leads to political unrest and various other sorts of negative, adverse situations that the country can't deal with. Now, as I was saying, so what falls into this category of infrastructure? So we've got energy projects. So this could include any and all power plants, from coal plants, gas plants to solar and wind plants. It includes the transmission and distribution of that, the pipelines to send gas from one area to another, and energy storage as well, substations. That all falls into this energy bracket. Transport includes roads, bridges, airports, seaports, railways, and mass transit systems, cargo ports. And I guess a modern system of the future, you could put in things like Hypertunnel in there as well. Sorry, Hyperloop. The telecom space, what was once just a traditional telecom space, now extends to fiber optic networks, 5G, data centers, wireless comms, satellite systems. So telecoms is grossly expanded. And even then, the telecom sector in a lot of areas has grown to also hold the monetary system. So a lot of the emerging market use the telecom system to send and receive money. As I said, social infrastructure, schools, hospitals, government buildings, and other public facilities. One deal that I've worked on in the past was actually for a sports hall for a university in Africa. So there's different forms of infrastructure at different levels. So you've got the higher ups of government, and the closer you are to this, and like energy falls in this category, transport, telecoms as well, because these are seen as critical infrastructure. I would say that these are your safer investments as opposed to doing those structures like what I just mentioned there, like gym facilities. It was only that the investment made sense over time that you make sense. So you have to do a lot of due diligence to work out whether these other sort of social investment projects make sense, and also the way you're financing these projects as well. So if you've come up with any innovative financing mechanisms, for example, running a school, okay, if you've got enough fees for students to pay, or you've got a model that could be easily projected, then these are very investment worthy projects. Water and sanitation, this is a huge one, especially right now. It has been said for years that water would be what wars will be fought of in the future, and it's already begun. We've seen it in North Africa with Ethiopia and Egypt, and this is only going to get worse. So, dams, reservoirs, water treatment plants, wastewater management systems, and distribution networks, these all fall into sort of water and sanitation. So, any cleaning, and also I would mention their piping to more rural locations, extensions, interconnections of those networks into other countries. and energy as well can fall into that category as well. So the key characteristics of infrastructure, it's long term. So these contracts are structured over either fixed payment or they're tariff or lease based. And they're on a 20 to 25-year contracts. For example, contracts that I work on a sort of a power purchase agreement basis on the energy side, these are generally on a 20 to 25-year power purchase agreement. And that's on a what we refer to as a BOOT agreement. So build, own, operate, and transfer. So that's the type of contract that we have with the government. So it's our responsibility to, one, finance, build the project, own the project, operate it, and then at the end of the 20 or 25-year term, transfer it. Another mechanism is I'll go into as well for financing these projects. And these infrastructure projects, it's not like you're buying a product and selling a project. You're often on a fixed contract, sort of debt repayment. It could be on tolls, lease payments, and for example, for as I just said, for me, I'm paid per kilowatt hour of energy I produce and send to the grid. Inflation protection is an interesting one. When we structure these contracts, what we do is we index it to currencies that we see as being a little bit more stable. And there's, depending on what markets we operate in. So for example, in more emerging markets, there could be some further concessions that are made or mechanisms used to diversify the payments made to us that allows us to hedge inflation. And a lot of the markets that I operate in personally, they've suffered significant inflation. They're only going to suffer more as they're pegging their local currencies to pay their bills in dollars. So they'll essentially print money to pay their bills, and it'll push them into a very poor position. And we touched already on the diversification benefits, that it's has a very low correlation with other sort of what we refer to as the financial economy, because it's such as stocks and bonds. All right. Let's go through we've touched on the benefits already, but I want to touch on the risks and how it's managed. So if we look at the regulatory and political risks, this comes down to what country you're operating in, what country that you're looking to develop the project in. In countries that I operate in, where we have high political risk situations where there could be changes in regime, government policy changes overnight, they're perceived as unstable areas. What we have is what we refer to as political risk insurance, and that forms part of the deal making process. So as you're developing these infrastructure projects, this PRI is what we refer to it as. This becomes part of that package. So whilst it is a risk, there's mechanisms that exist in place, and it just comes down to getting a quote and finding an insurance provider that covers the risk. And you'll pay a premium for that out of the project cash flows or the CapEx, depending on how that insurance is structured. Construction and operational risks, these are always the case. If you're the investment company and you're putting the money down, what you generally would do is you would subcontract this to an EPC contractor. This is the entity that's responsible for the engineering, procurement, and construction of the project. And you do that on a turnkey basis. So they're fully responsible for the end-to-end execution of the project. And anything that goes wrong with the project, they hold the risk of that. So that's one way that's handled. And them as an organization would also have insurance that covers their risk on the project. So that covers the value of their cost. So there's all these mechanisms to resolve the risks that exist. And like I'm dealing with hundreds of millions of dollars investments, and insurance companies are putting up these insurance premiums. It's how they make money. They're wanting to do these deals as well. So it really comes down to just making the deal bankable and making sure the structure that exists is a strong structure and it's investment worthy at the end of the day. Interest rate and inflation risks. So there's the interest rate in regards to debt. These on a debt perspective, the debt is negotiated prior to the execution of the project. So that's not necessarily a risk. There's the inflation risk if you're operating in markets outside of your own, especially in the emerging and frontier world. And depending on what insurance provider, insurance is becoming a key word right now, but depending what insurance provider you use, they can actually hedge some of that inflation risk as well and the currency risk. Some of the multinational organizations like MEGA that exists under the World Bank, they they can protect your investment returns as well because they're incentivized to push investments into these regions. Environmental and social risks. When you're taking on some of these larger infrastructure projects, there's a series of studies that need to be conducted. And when you're financing them, you have obligations to the biggest lender in this, which is generally an institution who are going to put up upwards sometimes of 90 up to 90%, but generally around 70% of the capital costs required to build out the project. So they have required that you perform to what we refer to as the IFC performance standards, and IFC stands for International Finance Corporation, and it's another organization part of the World Bank that invests in projects. And they've created these performance standards that all organizations, if they're lending money to, need to comply with. And that ensures that you're obeying these environmental standards, social standards, health and safety as well. So once again, like this forms part of your documentation, and for you to even develop projects in countries, the framework exists there. So your project doesn't exist until you've ticked these boxes. So whilst we highlight it as a risk, there's mitigation measures that are used on the daily by organizations all the time. So how do you get involved with infrastructure? How do you invest? So the easiest way is publicly traded infrastructure companies. So these could even be companies that are building out projects in the infrastructure space. So it could be like Engie, for example, the French energy provider, that you can own their stock. So that's one way to get exposure to these organizations. And I apologize because my references are to the energy space more than anything. And once again, like telecoms, communications, utilities, all of these generally in some regions have listed stock. Another way is through mutual funds, exchange traded funds. So the likes of BlackRock, Blackstone, they've got funds. ETFs are portfolios of an index essentially that you could fund. It's liquid, so you could trade it. That is made up of various different infrastructure investments, whether it be stocks or bonds. And as I said, you've got the BlackRock, so you've got the private equity side of things. So with the PE companies, either you invest your capital directly with them and they invest it for you in these projects. They take the responsibility for doing all of the due diligence. And I've always through the bond market. So the bond market has all of and the bond market is different to the equity side of things because you're getting a fixed rate. So you'd have an agreed upon premium that's going to be paid to you on an annual basis, as opposed to owning the infrastructure asset on the equity side of things. And all of these that I've just mentioned now so far, they, other than buying into publicly traded infrastructure stocks, you have very limited access to as a retailer. And infrastructure assets generally are difficult to fund as an individual or even to get exposure to as an individual. I've been fortunate enough to operate in the space, and I would say that it's difficult to operate into, but it's not impossible for someone to go out there with and even take equity stakes in projects, develop them from greenfield or brownfield sites, raise the capital and actually undertake these projects by yourself. And a lot of countries now have got regulations that do allow you to do these and start up these project investments yourself on a sometimes a smaller scale, sometimes on a larger scale, but it really comes down to growth. So you can start on smaller and start up and grow up, sorry, to a larger asset size over time. So I'm going to go through the process, and then I'm also going to go through how one as an individual could actually do this themselves. And this is based on my own experience and things that I've done personally. So, look, the first thing is identifying potential opportunity. And I'm going to use the energy space as reference to describe this. So, possibly I found an area which has a high energy price, they've got a large availability of land, and they've got regulation that exists. So, that's a potential opportunity for me. I run a high level feasibility. So, I assess whether this is a real project that we can actually dedicate some time to. And after that, we develop the first sort of business plan idea that we want to take forward to the government bodies who regulate these types of infrastructure assets. So, for example, on an energy project, you might be going to the Ministry of Energy, or you might be going in a country with privatized utilities, you might go to them directly. Either way, you'll need to liaise with all of the stakeholders that are relevant to understand what is the project development process, and from then on you'll develop those relationships with that body as well. You'll then start to develop your investment memorandum, understand what the cost of this infrastructure asset is, build out the financial model to understand what the returns are. You'll start the negotiations with the government for the contract. So if it's an energy project, this would be the power purchase agreement. If it's a water project, like a desalination, this could be a water purchase agreement. And once that's done, you start on the preliminary studies. And this is where you'll do your environmental impact assessments, or your EIA. If it's an energy project, or even actually probably most infrastructure assets, you'll have to do ground studies, so geotechnical, topographical studies as well. And then by then you've really got everything in place. And sorry, just to dial back on negotiate contract with government. As part of this, you're also negotiating your securities for repayment from the government as well. So maybe they offer a sovereign guarantee on the larger infrastructure sides of things. So we're going back, sorry. So once the studies are done, it comes down to securing insurance. So shopping around the market, dealing with insurance brokers for that insurance that would cover the investor who's going to invest money into the project. So the debt portion is probably the most important here, because that's the individual, the entity that's putting up the largest sum of capital. So you shop around, you get your premiums, you understand it, and then we can understand what all of the full costs are needed to develop this project from start to finish. And that, bearing in mind, up from identifying this project opportunity to here could take over a year and could take even longer. And I've met developers who've spent over 10 years in some situations developing assets. And that's just been due to unforeseen circumstances in the countries they've been operating in. So once that financial model has been closed, you start the fundraising process. You have an understanding of how much equity you have and how much debt you have. So you go there, you reach financial close, and only once you have all of the money needed in your project SPV do you start the construction. And as part of that construction, you negotiate the contracts with your EPC contractor, whoever's building the project for you. And then the project's commercially operating, and you'll generate your revenues according to whatever contract you've negotiated with the government. Now, that's very much, I probably simplified it so that everyone can understand it, but it is very much this process to getting a project developed from start to finish. Now I'll go into how you can do it yourself. These first three, are exactly the same. You don't have to expense any money here. It really comes down to identifying the opportunity, running your feasibility, and developing your. And when we refer to as a business plan, it's more of an idea and a concept, and researching as well. So up to here, you've got probably a lot more researching to understand even who these government bodies are. And once you've spoken with these government bodies, you understand then, okay, what is the process to get from here to the point where I've negotiated the contract with the government and have it signed. So that's where you get this understanding. And once you've got that, you also know what costs are needed. Now, this is where you'll probably look for your first requirement of money. So this is actually where you're going to start your first fundraise. And it's not necessarily a lot of money to get from here to here in the grand scheme of things compared to a lot of assets, but it could be in most situations, it's money that you might not necessarily have and don't want to put all of your capital at risk to. So what we would do here is I would, and I have done, is go to market and I fundraise for what I either call a credit note or a convertible note. The credit note is just a form of debt. So I would take some short-term debt on based on the idea that I would pay it out once I've got an exit on the project or on the term. The convertible is based on them putting up the money now based on a valuation that's decided on what the company is today, and them being able to then convert it to equity in the project when the value of that has then increased, but at the value that they had negotiated at. A little bit complicated, so I'm going to go over that again. They issue debt at 0.1 at your current valuation for the ability or the option to convert that debt at a later date at a newer and higher valuation, but at the valuation that they had negotiated when they issue the debt. So that's the idea of a convertible note. So this is where I would issue a convertible note out and I'd go to market, and I've got various investors, family offices that I work with here. And it comes down to who your investor or what your investor profile is. At this stage, I can't go to an institution. I can't go to a large infrastructure development bank because there is no project. And I have this conversation with a lot of people because a lot of investors consider a project at different levels. Certain venture capitalists at seed stage, they identify an opportunity at this stage. This is a company, this is a project. Whereas you get some people that don't even consider this a project until the project's operating, not even when they've got a signed contract with the government. So different investor profiles have different expectations of what a project is. So at this stage, I'm going to family offices is generally my go-to here, private investors of high net worth individuals. Now, my second fundraise, and at this point, I'm actually looking to raise the money, not just to get me to the power purchase agreement signing, but to get me to this point, financial close. This doesn't mean that I've paid my insurance. It just means that I've got to the point where I'm in a position to then raise finance for the whole project. So I want to cover the cost of also doing the preliminary studies, but also have an idea of what the insurance is. Now, I can understand that there's probably a lot of like, how do I put together a financial model? And there's loads of consultants that you can work with. And if you can develop relationships with them, you could even offer them equity deals in the project. If you can prepare a financial model for me, I'll give you this percentage in the project when we commercially operate, for example. So you'll develop these relationships along the way. And that's exactly how I operated, and how I've got to where I am today has been through those relationships that I've developed by just trying to do this myself. And it took me 2 years and multiple projects to successfully do this to myself. Now I'm at the point where we can do this with every project that comes on our table. But it did take a lot of learning, and I've got a lot of the network to take these projects on and to bring the finance at the various stages that it's needed. So whilst infrastructure has generally been an investment that has been reserved for large institutional banks, there is opportunities for investors that sit outside of funds and publicly listed companies where they can get exposure, and the investment is probably a lot more valuable. It is significantly more valuable than owning the stock, because what you've developed here hasn't cost you anything. And by the time you've got here, you've got a project of a value. And depending on what the size is, the work that you've done, whether it be, and I'm going to use energy for a perspective, whether it's 10 megawatts, so 10 million US dollars, or 250 megawatt, 250 million US dollars, the work to get from here to here is exactly the same. So the valuations are equal in footing in terms of what you're able to achieve from start to finish, from 0 to 100 is what you're achieving. So it's not without its challenges, but it's also, people have access to these opportunities. And I think it just comes from shopping outside of where you normally are. And look, there are smaller infrastructure opportunities out there. You could argue that providing smaller infrastructure as a service to end consumers, so being able to sell solar and lease solar to residentials, for example, or smart water solutions to them as a service, these kinds of things are another form of infrastructure, but on a much smaller scale. And the investment criteria that are needed are generally the same, and also the mechanisms for fundraising along the way are. So that's the end of that.
Woo! Good call.
Is that nice?
Brilliant stuff.
Interesting.
How do I end this?
I don't know.
Don't
You're the
do it, man.
master.
Don't end it, bro.
I
Keep
don't
it
know.
running. Turn it to a live stream.
I don't know how to end the recording.
Click end.
The buttons disappeared, man.
Exit full screen.
Zoom. I'm not even on full
Control,
screen.
Alt, Delete, Alt F4.
I'm on a thingy.
Make sure you scroll down to your dock.
Smash the power